Welcome to Chartered Accountant's Pen. In this video, we'll explain IAS 16 property, plant and equipment, including its objective, scope, measurement, cost model, disclosures, and comparison with US GAAP's ASC 360. The objective of IAS 16 is to prescribe how to account for property, plant, and equipment. It helps financial statement users understand an entity's investment in tangible fixed assets and the changes therein. IAS 16 applies to tangible items used for production, rental, or administration. However, it does not apply to biological assets covered under IAS 41 or to mineral rights and exploration assets. PPE is recognized as an asset only if it is probable that it will generate future economic benefits and its cost can be measured reliably. Property, plant, and equipment are initially measured at cost. This includes the purchase price, taxes, directly attributable costs, and obligations for dismantling and restoring the site. After initial recognition, PPE can be measured using either the cost model or the revaluation model. The revaluation model must be applied to an entire class of assets, not selectively. Depreciation is charged to allocate the asset's cost over its useful life. Useful life and residual value must be reviewed at least annually. Entities must disclose the measurement method used, depreciation methods, gross and net amounts, movement during the period, and any restrictions on asset titles. Under IAS 16, entities may choose to revalue assets to their fair value, provided that revaluations are made regularly. Entire asset classes must be revalued. Under US GAAP, PPE is always carried at historical cost less accumulated depreciation and impairment. Revaluation is not allowed under US GAAP. When parts of an item of PPE have different useful lives or consumption patterns, they must be depreciated separately under IAS 16. While, according to US GAAP, the same treatment is acceptable, it is not mandatory. Most entities depreciate the asset as a whole. Under IAS 16, IAS 36 applies. Impairment occurs when the carrying amount exceeds the recoverable amount, higher of fair value less costs to sell and value in use. As per US GAAP, there is a two-step approach. The first step is the recoverability test. Is the carrying amount greater than the sum of undiscounted cash flows? If yes, write down to fair value, usually market value or discounted cash flows. There are two cost models under IAS 16, that is, either the cost model or the revaluation model. However, as per US GAAP, PPE is recognized on the cost model only. Depreciation is reviewed annually for changes in useful life, method, or residual value under IAS 16. Under US GAAP, changes are also permitted, but less emphasized. No specific requirement to review annually. Residual value must be reviewed annually and adjusted if expectations change under IAS 16. Under US GAAP, also considered, but changes in residual value are typically made only when necessary. Let's say you purchase machinery for 1 million rupees with a useful life of 10 years using the straight line method. Annual depreciation will be 100,000 rupees, recorded as a debit to depreciation expense and a credit to accumulated depreciation. Thanks for watching Chartered Accountant's Pen. Don't forget to like, subscribe, and click the bell icon for more insightful accounting videos.